Every once in a while, we run into some areas where short-term patterns may make sense. U.S. market holidays are examples of these short patterns. What I did was there are roughly 9 holidays that we look at where the markets are closed, and I've got enough data on these patterns to find out which ones have the best bullish and bearish events on them. And so again, I'm looking for high probability events, but these are typically using weekly options for about a week or so. I ran the pattern looking at before the Christmas holiday for any buying opportunities. I squeezed it down to just ETFs. They're the most liquid things that are out there, other than maybe the Mag 7. I want to show you how I did this and what looks like a good fit this week. This is my money counter scan. Now, what I did was I went into this area right here and I made a change. I left everything alone except for this little guy right there. Instead of saying all and looking at stocks and ETFs, I said, just show me the ETFs, all right? And the other thing I did was I changed to 20 to 40 days, and I looked at 5 to 10 days. I just want to look at the next week or two going into the holidays. And boy, let me tell you what that did. That shrunk the number of, doing those few changes, shrunk me down to a handful or less of particular trading opportunities. For instance, this is what came up today. Today, I had patterns, and these are all 90%ers in Nugget, GDX, GLD, GDXJ, USO. So basically, I had 4 patterns in gold and 1 pattern in oil. Now, what are these telling me? These are all 90% patterns that start today and run, as you see here, the next 7 trading days, 7 to 8 trading days. So this takes us right to before Christmas for the majority of these, right to before Christmas. Now, I ranked these. I re-ranked these. Obviously, they're not alphabetical. I ranked them by which ones have the highest power meter. Now, power meter is a way of looking at a trend and getting an idea of whether that trend is getting better as we get to now that versus 10 years ago. And so as I'm looking at these patterns, Nugget hit the top. Then it was GDX, GLD, and then USO down here at the bottom. So out of all 4 of these, I have to go with a gold trade. Why? I'll back up and show you again. Because 4 of these 5 potential opportunities were in gold. Now, you might say, wait a minute, Tom. Hang on a second. Hold on. Right now, you recently said that gold was neutral. It is, but I'm talking about looking at 30 days or longer, right? I'm not talking about the holidays where when you look at GDX, for instance, GDX, 9 of the last 10 years, the last 9 years in a row, this thing has been profitable if you bought it 7 days before Christmas and you got out of it Christmas Eve, right? Maybe the day before Christmas Eve. You don't want to be getting out when everybody else has already gotten out of town. But look at this. Look how many times this thing hit in 2017, 4.69%. That was the return, buying this and then selling it a little more than a week later. 3.32% return in 2019, 3.98% return in 2021, 4.48 in 2022, 4.10 in 2023. And look at this regression line. Now, the average is going to be in here at around 2.5, but the regression line, that's how we create the power meter, is telling us right now, this thing's over 4%, it's about 4.5%. So we could take that information and do something with it. Now, the Van Eck Gold Miners, which is GDX, is trading right. Well, it was trading a little while ago at 36.35. If I put a conservative target on this of 37.50, all right, 37.50, and I think I may have gone way conservative on this one, all right, because if we take 4% and we add that to 36, that's going to give us somewhere around $13, $14.40. So that puts us up around $38, about $38 for a target on this. So spot the opportunity. create the alternative risk trade, and that could be buying GDX, or it could be maybe buying a call option on GDX. If I were going to buy a call option on GDX, and this is a case study. Now, if I'm looking at, for instance, I looked at what are the 35 calls trading for? I want something that's a little bit in the money, gets rid of some of the time risk, because I hate time risk, especially on a 1 week option. So the December 27 call, 35 calls are trading for $1.57 when I snapped this. And what I'm telling you here is that if you own the 35 and you pay $1.57, what is your break even? $36.57. If the shares are trading at $36.35, what do you got? Less than 30 cents, 32 cents of time risk. The majority of that is real, and that's great. What we're doing is we're trying to, simulate buying the stock, and by going into money a little bit and getting rid of the time value and putting more intrinsic value in there, then you're using this call option as a surrogate for the stock. So that's an idea. If we went to $37.50, the stock or the option would be worth a minimum of $2.50. You'd have a 40% ROI. If it went to 38, obviously you would have more.